Well, all right, all right. I'll meet here with you. I am so sorry I've been gone for the last couple of weeks traveling, and you've got just the email updates. But today, you guys get a video. How exciting is that? Without further ado, let's jump into it because I got a ton to cover with you. Here we go. All right. So, as always, we're going to start out with oil prices. We're going to start out with this war. So, it is number 178 days since this conflict has started. And it has started and stopped and started and stopped countless times, as you are well aware. Last we left our heroes on 8.3. The crude oil prices were $80 and $83. WTI is only going up $84. Now, mind you, over the last couple of weeks that I haven't been with you, it's ebbed and flowed a lot. But Brent crude is sitting at 92, which is almost $10 higher per barrel. Now, surprisingly enough, some of that has shown up and gone up and down. But our average state gas prices, 410 to 526, this is fully leaded, or this is regular unleaded, I should say. And so, gas prices are still up there. I just pumped $6 the other day for super unleaded somewhere. And so it's definitely starting to really take effect. Now, as you all know, gas prices are very closely connected with mortgage rates because of the fact that this is something that we all have to spend money on, and it is inflationary in nature. So, what does that mean? Well, we just crossed over something that we hadn't crossed over before, and that is this. So the US national debt now is at $40 trillion. $40 trillion. That's a lot. We hear so many of these numbers, they start to be meaningless to us at some point, but let's put that into perspective. Monthly interest payments. I want all of you mortgage owners and I want all of you car loan owners to go and look at how much you pay for interest on your stuff each month and then look at this. So, we as a country are paying $96 billion a month on our $40 trillion of debt. That's $132 million per hour. That's $2.2 million every minute, $36,000 a second. And so this debt, unfortunately, is in and of itself going to cause us a lot of problems. And I'm sure you've heard about what Scott Bessent did last week in the news. He had introduced this thing that he wants to do called the yield curve control. And what this is basically the 30-year treasury. Now, remember, the 10-year treasury is what mortgages follow, but the 30-year treasury is very, very impactful. Why? Because when that yield curve goes up, meaning that, hey, I need to raise a bunch of funds, I need to raise a bunch of money, so I'm going to give you an IOU. But in order to attract you, I need to offer you a very high rate, which is exactly what you see down here is what happened on August the 18th. The 30-year treasury hit an all-time high since 2007 of 5.33%. So Scott Bessent comes out and says, hey, look, here's what we're going to do. We're going to yield curve control. And it really is, in my humble opinion, a Ponzi scheme. Why? Because you borrow short-term money. So they're lending out or they're doing IOUs or bonds for short-term. When they gain that money from either corporate or regular citizens or whatever that is, then they'll go back out and they'll buy the long-term treasury and they just rinse and repeat. So it's borrowing from Peter to pay Paul and kick that can down the street. And as you can see here, this is where it was announced. You saw it kind of dive down. As I understand it, this was a lot of the traders kind of just covering their own paper. But very quickly, it picked right back up the next day and it came to 527. And as of this morning, it's sitting somewhere probably 526, 525. So what this means to mortgage rates is that you're going to see a fair level of volatility, perhaps even more so than we have in the past. So the word to the wise here is keep an eye on your mortgage loan officer, interact with them as much as possible. And if you're a customer who's under contract, be sure that you understand the ramifications of floating or locking because these rates can turn quickly. Okay. So the other thing that's affecting us right now is as of this morning, Trump has released additional and new tariffs on Canada. So there's up to a 50% tariff now on select Canadian imports, which include hockey sticks and furniture and alcohol and building supplies and textiles to make clothes. Now, probably the thing that's going to affect us a lot is the building supplies, which includes lumber, cement, steel, aluminum. That's pretty rough. And so there's a 50% tariff on all that stuff coming in to the US from Canada. And again, remember, tariffs are not paid by the other country, regardless of what it is that anybody's trying to tell you. Tariffs are paid by the retailers that import that stuff into the US, and furthermore, they're paid by us as the consumers when we buy things. Okay? So that's what happened here this morning. Canadian Prime Minister didn't waste a whole lot of time and gave us back some retaliation, and said, hey, here's what we're going to do. We're going to do a 50% tariff on the steel, on the dairy, clothing, plywood, electronics, and alcohol that comes in from the United States. So it's just this tit for tat thing is not going to help anybody, and it certainly is not helping mortgage rates, which is what we're here to discuss. Okay. Speaking of rates, so mortgage-backed securities are suffering a fair amount, as you can see here, as of late. And remember, this chart is inverse of what it is that rates do, right? So green, good, rates are getting better. Red, bad, rates are getting worse. And right now, they're sitting here in the belly of it. And you'll notice there's a fair amount of testing these Fibonacci levels of support because it has absolutely busted through the 200-day, 100-day moving averages. By the way, guys, if you're new to our channel, these moving averages are essentially a trend meter of where things have been for the last 15 or 25, 50, 100, 200 days. And they help us monitor what we think the bonds will do. Last time we visited, the 10-year Treasury was at 4.68. Today is sitting at 4.70. On the books for today is the ADP jobs report, the Case-Shiller home price index, as well as the FHFA home price index. By the way, some confusion here. People think this is FHA. It's not. FHFA is the management company that runs Fannie Mae and Freddie Mac, etc. And this is their home price index that basically measures the gain on homes values that are bought with conventional loans. The Case-Shiller encompasses everything. These guys only encompass conventional loans. Okay, the PCE, the Fed's boo-thang, the Fed's favorite way of measuring inflation, is coming out. You got to laugh at it. There's nothing else you can do about this stuff. It's coming out on Wednesday. Jobless claims with a little winky wink is coming out on Thursday, so we'll see how that looks. And then Friday, new Fed Chair Kevin Warsh will speak at the Jackson Hole Symposium. This is where all the folks from the central banks in the world get together and stare at this piece of paper and go, how are we going to fix the situation that everybody is in? By the way, the entire world, this thing that we saw right here, let me go back. This guy right here with the $40 trillion. I don't know if we should feel bad or not feel bad, but the entire world put together is in debt $315 trillion. $315 trillion, and we're at 40 of that is ours. Other developing nations also carry a fair amount of debt of their own, so we're not the only ones. All right, today's mortgage rates as compared to, what was that, 2 weeks ago before I started traveling, 6.82, 6.92 is what it was then. It peaked out and has dropped and settled just a bit, 6.78 and 6.88. Remember, these are national averages based on 25% down, 780 credit scores. So you be sure to visit with your favorite mortgage person to make sure that you're getting the right rates. Okay? All right. Well, with that, do me a favor, subscribe, like, comment, share all this so people can be as smart as you are, and keep hanging in there. Keep your chins up. This stuff will see itself through one way or the other, but be smart about your money. And if you need help, give us a call. We're more than help you out. Okay? See you.